We then focus on the I, which is all about independence and trying to make sure that we know the ways that we can create income for ourselves. And so I and the concepts that are associated with that independence factor will allow us to move forward. And again, there are 13 concepts that I think are important to understand when it comes to just making sure that you feel that independence. First is we'll talk about debt management and just making sure that you have a plan to eliminate your debt. It doesn't just mean paying off your bills, but it means this process of taking on debt so that way you're able to achieve certain things and then having a reasonable plan of paying it off. So it takes away some of your stress, but it also gives you a degree of financial freedom. And so the way in which you manage your debt really allows you to have more wealth if we can do it pretty successfully. And that simply means understanding the difference between what good debt is and what bad debt is. We need to actually finance things. We need to take on debt so that way we're able to gain more assets. And so it's not a good belief system to say, oh, I just don't want to take on debt because all debt is bad. That's not the case. When we finance a car or we pay a mortgage or we're using credit cards to give us like emergency and flexibility, those are good forms of debt. However, when we just have credit cards and we spend it just for retail therapy, that's not. And that just creates a higher expense, more useless items, and kind of it's probably masking something else that's a little bit different. And if we're talking about debt, whether it's good or bad, it's important to know what your credit score is. And your credit score is something that is an algorithm generated by a company known as FICO. And FICO kind of creates a certain scoring system. And the scoring system allows companies to have a range of what they believe is a reasonable amount of risk associated with you based on what's happened over time. It's important to note that the FICO scores are pretty standard, or credit scores are pretty standard type of algorithm and equation. And what that does is it feeds into credit agencies. And as a result of that, those credit agencies generate what are called credit reports, right? And so each agency is able to generate a credit report based on their criteria and their evaluation and their interpretation on what your credit score is. And so a credit score feeds into our three different credit bureaus or credit agencies. They produce individual credit reports, and those are the things that we see most often that list the items out that are delinquent or that are subject to some type of collection. Should also be aware of interest rates. If we're using good debt and bad debt, that's the cost of borrowing. So it's really how much it costs us to take on any form of debt, good or bad. And if we're taking on good debt, it's usually reasonable price. And we know bad debt because they have high interest rates, which means that we don't really have an opportunity to grow wealth. We're more so paying the expenses. And so ensuring that we are actually getting the right interest rate when it comes to our debt is going to be important. It's also important to consider your interest rate. Like you have to increase your income and your earnings every year. Why? Because things around us go up in price, and that's called inflation. It's where the cost of goods and services are going to go up by a certain percentage every single year. And if you don't keep up with that increase in that percentage, what you're going to see is a loss of your purchasing power. And so inflation really gives you a guide of how much you need to increase your earnings every year and whether or not you're in a winnable situation or not. If inflation is growing higher every single year, then the amount of money that you're making, if your earnings are not going up by equal amount, at some point you're going to be doing the same amount of work and it's going to be worth a lot less. And so simply understanding inflation helps us to understand our self-worth a little bit better. And then there are certain opportunity costs, and it's hard to really conceptualize this, but Sometimes you really just need to just take a risk. You actually spend the money so that way we take an opportunity because the potential benefit is going to be better than any of the alternatives that we have. And so when we look at opportunity costs, it's when we spend money for something that is beneficial, right? We look at it as something that can be a potential investment. Like, for example, going to college and paying that tuition, that's an opportunity cost. Why? Because it leads you to higher earnings over time, less regret as you get older, as opposed to how much you could have made or what you could have did. And so we invest that money now. We pay that expense when other people are not. Why? Because it gives us an opportunity to do something with it in the future. Because after that, it just becomes a sunk cost, right? It's a money that we paid, and then we need to benefit from it or grow. Because there are going to be certain times when we just pay an amount of money and then we have to go and be successful. I never, it sometimes happens if somebody takes like 1 year of college and then they drop out, but they have 1 year of student loans. That is just going to be a sunk cost. You've taken 1 year of college, so you haven't completed the entire curriculum, and you have a year of debt that's not really going to allow you to benefit yourself. And so now we just have this sunk cost, a bunch of money that we've spent that we can't really do anything that may just lead to other bad financial choices. In reality, if you wanted to only take a year, like take 2 years and then drop out, because at least you're able to get an associate's degree and you're able to do something with that. But really taking out a loan for school and then dropping out after the first year, it really just puts you at a really big disadvantage. And then when it comes to debt, we can think about different ways to pay that off. One is called the snowball method. And that just simply means if I have several forms of debt, like credit cards and car loans or whatever the case may be, that I start paying off the smaller ones. And once those smaller ones are paid off, I can move on to some of the bigger ones. And so it helps when you're just you really want to just pay off something really quickly. However, sometimes we can deal with what is called the avalanche method. And so we just pay off the highest interest rate first. Why? Because it's costing us the most. And if we actually take that debt away first, then we're not wasting as much money. We're not paying as much in interest costs. And so that would be a much better situation for us. There's then risk tolerance, which is how comfortable you feel with investing. No one feels comfortable with it, but it's something that needs to happen just to be able to increase your wealth. And at a bare minimum, when we look at the equation for risk, we normally say 3% is the lowest amount of risk or is the lowest return that somebody should look for if they're not willing to take on any risk. And so that's pretty conservative. So if we have a fairly low risk tolerance, we're probably looking at something that's going to average around 3 to 5%. Whereas if we have a higher risk tolerance, we can actually stomach investments that can gain 10 or 15%, but it's going to happen with some volatility. And so that allows us to really have a better understanding of what the risk tolerance is. And financial independence is essentially what it sounds like. It allows you to know that you have enough wealth. You don't need to be rich. You just need to have enough so that way you can live without working, where your money is working for you, or you're able to attain or influence the way in which you can get cash flow. And so as a result of doing that, you're able to achieve financial independence. And that doesn't necessarily mean you need massive amounts of wealth to do so. And that's really the old way of thinking about retirement, where we just save and we do so over a period of time. And at some point when we're older, we get to just retire and be happy. But if we just want to work for a period of time and then we don't want to, that's still a part of retirement planning, right? It's just preparing for what we need to do financially when we're not working anymore. And we can decide what that number is. It doesn't have to be 65 or 62 or 70. It can always be your choice. And that's one of the things that retirement planning is very nuanced and understanding.